Will an imminent recession cause you to cancel your summer vacation? Let's find out together. I'm Michael Smith. Welcome to the Lowdown. Hey everybody, I'm Michael Smith. Welcome in. Today joining me is Kevin Lenox, and today we're going to talk about, is a recession imminent? Kevin, welcome to the show. How are you doing? Great topic,
we
right?
thought last year was tough, but this year already feels like a full year.
I know, and we keep saying that we hope the next year is just, going to be better, but it keeps compounding. Obviously, coming out of a pandemic, it's probably to be expected. But last year we were talking, and we were on the show talking about recession. Inflation was the big topic. We're starting to see inflation coming down. CPI came in better than expected. So that's certainly good news on that front. And we could probably go into that a little bit. But right now, I think the biggest fears is recession, right? That's what the word we're hearing. And so if you kind of put it into perspective, right? So what we have right now, or at least last year, the probability of a, kind of a slow recession, a gradual recession is probably the most advertised recession we've ever heard in our career, okay? But now you're starting to hear the probabilities of a hard landing. So this is a different type of recession. As a matter of fact, this is the type of recession we saw during the great financial crisis of 2008, 2009. So kind of just put that in perspective for a minute. I mean, right now, a gradual one means you're starting to see things like credit and consumption, they're gradually slowing, right? And that's kind of where we are. If you think about where we are at the moment, that's where we've been. The consumers we've all seen prices go up. We know the cost of food. We go out to eat for dinner, it's double, but we're still doing it. Maybe not as much, but we're still doing it. Because the jobs, wages have remained there to support this. And of course, credit, right? And we've seen people go out and get lending to keep their lifestyles going. But a hard landing, this is something much different. A hard landing is where basically credit and consumption cease immediately. So right now, we're all about to go into the summer. I think everybody's got plans for summer vacations, wherever it may be. But you've probably thought with the gradual, do I need to maybe pare back? Do I maybe cut back on this? That's kind of where we are right now. Where the Fed is starting to take us because they raise rates again, and I think we both agree the Fed has gone too far. But where we're heading is, do we basically just shut down and cancel the summer vacation and the consumer freezes up? That is where we hit into a hard landing. So I thought I'd throw that at you at the beginning and get your thoughts on that. Yeah, you're welcome.
Well, everybody's situation is different, and I don't think that a hard landing is a guaranteed case at this point. It's become much more mainstream, much more likely. I will preface it that, we all have as portfolio managers our own bias, our own process, how we do things. Mine was built around credit and credit markets. So we are seeing now over the past 6 months, really, a heightened level of restrictions in credit. So we talked about last time the Senior Loan Officer Opinion Survey, and it showed that 46% of banks were tightening lending standards for commercial and industrial loans.
Correct.
That's historically in recession territory. That's a leading indicator that hasn't missed. When companies try to get access to credit and they can't get access to credit that they need at a reasonable price, things slow down. It then eventually hits profitability. When it hits profitability, then that's when layoffs start.
And so we're starting to see that's showing up now, right? Well, here's the question I have. I mean, you're talking about leading indicators, and I agree with you. What's leading indicators? That's what we should be looking at. That's what the Federal Reserve, Jerome Powell, that's what his team should be looking at. But that's what they're not looking at, right? They're looking at backward-looking data. And if they were looking at any leading indicators, they would be seeing that the consumer is about to hit that moment that I just talked about. They're about to, at some point, they're going to hit a wall and freeze. And I agree with you. I don't want to get there because to unwind that, that's losing confidence, for one, in the Federal Reserve. To gain that confidence back, as you know, gaining confidence back takes a long time. What should the Fed be doing at this point, or what are they doing wrong?
I think they've overcooked the ribeye.
They have. So is it charred or is it just well done?
heavily charged.
Okay. All right.
So the 2-year Treasury is almost 4%.
Okay, yeah.
And it's the Fed against the Fed funds rate, which is 5.25%. Now, the 2-year Treasury is pricing in multiple rate cuts. It's a probability distribution that either we have a hard landing in a recession and the Fed has to cut very aggressively, versus what they're saying right now is that they can hold rates steady for the balance of the year. So we look at the rates market. The rates market is saying recession. We've had an inverted yield curve since the middle of last year.
Another good predictor of recessions.
Yeah. Cyclical stocks are sharply underperforming defensive stocks. So you have a flight to the more defensive stocks when you have to be in the market, but you're trying to reduce risk. We've also seen a sharp outperformance of large cap stocks versus small cap stocks. The small or the consumer financial stocks like Ally Bank, Capital One have more of a subprime presence in their loan books.
Yeah.
Those stocks are drastically underperforming the likes of American Express. So that's another thing that we look at kind of, underneath the surface to see. And just as we look across within different asset classes, it's all pointing to positioning going the same way that you're not seeing in the S&P 500, because the big 8 tech stocks account for over 90% of the gain in the S&P 500 this year. The average stock, if I think you take those out or you just do an equal weight, you're just over 1%.
So participation has been very small.
And that's another indication that the risk reward in stocks is not favorable right now.
So if I was at the Fed and had listened to everything you just told me, that would indicate the consumer is actually probably going to start to slow down. And if you look at business spending, CapEx spending, all these different things, that's going to be difficult. What functions in terms of the economy is about to churn. So wouldn't you at that point think that, you might want to change the direction that you've been heading? Why is that not happening?
So I've got a chart here. The Fed keeps talking about this hot job market. I really don't think it's as strong as they think it is.
Explain that.
I've got a couple of, there's a monthly purchasing manager index survey done for manufacturing companies and for service companies. It's a good tool to use just to get a pulse on the economy. And at the top of the graph, it shows the results on a monthly basis of the survey, just the employment side.
Okay.
And I have a big green arrow or a line going from March of last year. And if you look to the left of that, the PMI numbers are above 50, which means growth, which means companies have been hiring, both the manufacturing sector as well as the services sector. But once we crossed March of last year, that very much flattened out to right around 50, which means very little hiring. And we look at how recruiting company stocks like Robert Half and ZipRecruiters, those stocks peaked early part of last year. If we have a red hot economy, those stocks should be performing much better.
Absolutely.
They're not. And lastly, if you look at the slope, the left of the green line of full-time jobs, it was moving up before March at a decent pace. Very much leveled off since then. We had this hot job growth, and it's not really filtering through. And I think one of the labor market has changed. And
it has changed.
The BLS is having trouble with that, but their birth-death model is, I think, a huge rounding error for them, in that it's showing 1.8 million jobs created over the last, since March. It's just 43% of the jobs created.
Yes.
Powell keeps looking at that and the jolts, which is shown to be an inferior measure of the labor market. And they're looking, to your point earlier, they're looking at lagging data, not leading data, which points in a different direction.
So, that kind of gets me thinking, because remember, Powell came out and he told us he wants to, basically put the death in inflation, right? And I think for some degree, I think inflation's probably behind us for at least a good while. You've seen it coming down. We're looking at some of the components like shelter, that's still high up there, but that takes a while for it to come down. But if he looks at the employment data, what allows him to keep going, as long as employment, if he paints this employment picture to look better than it really is, was what you're saying, then he can keep raising rates, right? He wants to be for sure the person that's basically killed inflation. He wants to be the Paul Volcker. That's his. So there's a lot of ego happening here for what I'm hearing, what I'm seeing. But what you're saying, and also the NFIB, the National Federation of Independent Business, their survey came out. Inflation is no longer the number one problem. It is now the quality of labor. Right. And so you're starting to see some underlines of really the strong labor number the Fed wants us to all see, so they can continue to tell you why they're going to raise rates higher. But when you start looking at the underpinnings, it's telling you a different story.
Yeah. And Washington wants to tell that more optimistic story.
Oh, of course. Absolutely. We're in an election cycle, right? You don't want to talk about deteriorating labor.
Right.
So where do we go from here? Where do you see things going? Because, again, right now, I think it's a gradual recession or a hard landing. And I think we're right on that cusp of turning it into the hard landing. How can we get to basically continue with a gradual recession and not have a hard landing? What, in your opinion, needs to happen?
So recessions and bear markets can correct themselves two ways. Mm-hmm. One is by, for example, the stock market price. We just go down sharply. Mm-hmm. The other is by time, just an extended period like we've been doing of just muddling through. The good news is that corporate earnings have proven to be very resilient. We're still trading at 20 times earnings, which is not at all cheap. And the market is being led by big tech, McDonald's, Hershey, and and Pepsi, and that's not what you want.
Well, they're able to pass on higher prices, the price over volume argument, right? For now. Mm-hmm. In a gradual recession, they're able to do it. But a hard landing, that would be a different animal for just about anybody. Yeah. So, I mean, if I'm the Fed today, I would be looking at these indicators and how do we not go into that hard landing? How do we maybe kind of glide path this thing back into a normalized expansion, right? And in my opinion, you can tell me if I'm different, is they probably need to start pausing at this point, at least starting to say, hey, you know what? Things are starting to deteriorate. Inflation's come down, and actually the CPI report gives them a little bit of an ammo to say, we're going to start pausing here, and that gives them the ammunition. But do they do that? That's a different story.
My guess is they will.
Okay. I like hearing that.
That's a hope.
Yeah, I know, right?
They've kind of indicated the bank shock, I think, got their attention. And I think there's a case to be made where they can just sit on pause and just wait for the lag effect of all the rate hikes that they've done. This has been the most aggressive rate hiking cycle in history. There's a 6, 12, some say 18-month lag before a series of rate hikes really take hold in the system throughout the economy.
And you've seen the chart on that, by the way. That is an impressive chart. And that doesn't even account for the quantitative tightening, which, by the way, no one at the Fed's talking about anymore. It's like the word's been just erased from their speaking at all. Mm-hmm. But that's actually added even more aggressively onto the tightening campaign.
So going back to the lending, which I think will be the key here.
Yes.
The key line from that senior loan officer opinion survey was that they expect to tighten credit for the remainder of the year across all channels. Kind of the silver lining when you look deep in the report is that the number of banks that are tightening lending standards considerably was only 3%. So if we can muddle through and things don't go considerably tighter, we might be able to muddle through and do that soft landing scenario, or moderate instead of the hard landing. So the odds clearly skew toward a hard landing.
Well, so basically what you're saying is Powell has a brief moment in time here to actually look like a hero. If he gets this right, reads this right, he can be known as, hey, you know what? I brought inflation down, maybe not to the 2% target, which is ridiculous, but he brought it down, relieved the pain, and then helped the economy get back on track. Or he's going to be known as the person that made this thing a lot worse.
Well, let's add too, Biden increased spending by 13% on a year-over-year basis. So it's a tougher job for the Fed to try to fight inflation when government spending is out of control.
Oh, yeah. Well, we could go to a whole other show on that. Well, hopefully I can keep my summer vacation.
I'm sure you will.
Well, thanks, Kevin. Thanks for joining us for the Lowdown.